Hi, everyone. Hi, James. Thank you so much for joining our panel today. So we're going to talk about LPs, doubt in VC startups valuations. So we're going to talk about venture capital. So you wear so many hats, right? You're an entrepreneur, book writer, chess master, venture capitalist. So today we'll pick your brain a little bit more on venture capital. So tell us, please, my first question to you. So LPs are the lifeblood of venture capital, right? So they give the money. So general partners obviously make investment decisions, but if they don't have money, right, they don't have anything to invest in. And right now, LPs are getting more skeptical about startups' valuations. So my first question to you, what's wrong with these valuations?
Well, it's a complicated question because it's all related to the economy, but it's also related to AI and it's related to the psychology of VCs. So, how many of you are entrepreneurs or have startups? So, entrepreneur. So you've been through the process, or you're going through the process of raising money, and it's confusing because here's what happened in a nutshell: between 2020 and 2022, there was this virus that was going around, and
Oh, yeah.
the U.S. government printed $4 trillion. Or $6 trillion. Sorry. So 40% of all the money that was created in the entire history of the world was created in those 2 years. And so where did that money go? It didn't all go to like people who were fired. The PPP program. It didn't all just sort of like, oh, we're going to build bridges and make the world better. It essentially went into venture capital firms and investment firms and banks then invested in venture firms. So you had more money raised in those years than ever before in history. It was about $430 billion was raised by VC firms just in those 2 years.
Yeah.
And about 200 billion of that money, so about half of that money has been invested. But now another 200 billion is just sitting there. It's the most money ever held by VC firms just in the bank. Like it's in their savings accounts. And it's their job to spend it. So they need to spend it. And by the way, VCs work usually with a timeline. They have to spend it in only so many years. So then you have 6 deals that everybody loves in Silicon Valley and every VC firm in the world chasing them. So what happens when there's high demand but low supply? Price goes up. So this
Yeah.
is the economy right now. Now, why might you then have a problem raising money in some cases? Is because only a few of these, it's not like every VC firm raised like an equal amount of money. Only a few VC firms raised all the $430 billion, and they all were basically based in Silicon Valley. So if you were living in Chicago, say, and wanted to start a VC firm, chances are you had a hard time raising money. LPs, to your point, only trusted Andreessen Horowitz, Benchmark, Sequoia. So these venture firms went from being kind of garage-style venture capital firms to major financial institutions. So they're a combination of banks, hedge funds, VC firms, and everything now. So now basically you have all this money chased by a few firms chasing only a few companies. So every month now there's new company. I think Perplexity started 2 years ago, is
Yeah.
now at a 1 or $1.5 billion
Impressive.
valuation. 2 months ago they were at a $500 million valuation. So somehow all the investors just doubled their investment. Who are the
Yeah.
investors? Jeff Bezos, Nvidia, Amazon, all the same guys are
We
invested
know
in all
these
these.
names, right?
So that's the problem. So if you're an so for LPs, VC firms those VC firms don't care about what their LPs think because their LPs are like, Dubai or the Kingdom of Saudi Arabia, like, institutions that really don't care if they lose money. They're just trying to get their money out of the Middle East in some kind of logical way. So it's kind of a blank check to the Andreessen Horowitz of the world. And so they're just investing. Now, they're investing in the cool companies. They're not going to invest in some shit company, but that's what's pushing the valuations of the cool companies maybe too high. And I say maybe
Yeah.
with a reason. And maybe I could keep going, but I want you to, maybe we'll get to some of these answers in your questions.
Yeah. No, this is great, and this is absolutely true. So basically, the valuations are overly optimistic right now. Yes, that's what we're saying.
Well, they're high. I don't know if they're overly optimistic because, last year, something like I don't know, $600 billion was spent on software, services, and hardware related to AI. $600 billion. So the GDP of the U.S. is 27 trillion. So if you have 600 billion, and that's rising every year, that it could be that AI single-handedly is what's keeping us right now from being in a recession, meaning, several quarters in a row of negative growth. $600 billion is 2% higher than is 2% of GDP. So if we had lost that 2%, we might be in a recession this moment. So and it's not a lot of companies that are contributing to this $600 billion in spending.
Yeah.
So there's not a lot of mom and pop shops of AI that are worth anything that are raising money and then spending it. So you really, again, we're down to a few small AI companies, both software and hardware. So like Nvidia, I'm counting among that, and they're spending all this money that's really just propping up the global economy at the moment. So the valuations might not be ridiculous. Like you look at Perplexity as an example.
Yeah.
They're arrogantly stating that they're going to defeat Google in
Yeah.
search, which I don't know. I looked at Perplexity. It's not really that impressive. They're an aggregation of a bunch of AI models. They don't have their own AI, from what I could tell.
Yeah, they don't.
And they tell you, okay, this is coming from Wikipedia. Here's the answer to your question. So I could just go straight to Wikipedia instead. So in that case, maybe it's too high. But here are the moats that I see these VCs investing in. Anything without one of these moats is probably worth zero. So they either have a large number of users, so Perplexity has 10 million users a month, or they have data that no one else has. So if you're starting your own AI company, ask yourself, do you have one of these? Do you have one of these moats? Like, do you have either, again, if you're a software company, there's different moats for the hardware guys. If you're a software company, do you have, are you, creating something? Do you have a lot of users, or do you have data that no one else has access to? And so I give as an example, I know of one company, they have a database of 185 million mugshots. So basically, everybody who's committed a crime, and I installed on the camera, so I know about 50% of you have committed some crime in the past. So everyone who's committed a crime in the past 30 years is in their database. So if they license their AI to Walmart, and you walk into a Walmart, they'll keep an eye on you if you're in the database. So that's a unique moat that someone just can't rebuild overnight. Well, the opposite of that is I have a friend who created a company that helps you make your resume. So he has an API with ChatGPT. There's no moat there. Anybody can make software like that in 24 hours. So that has no moat. So that's a case where the data is the moat, and a case where the software is where the users are the moat is like Perplexity. So software companies have one of those two moats, and again, it's very hard to get one of those two moats. It's very hard to have unique data, and it's very hard to get 10 million users. But if you have one of those, you'll get $1 billion valuation in this VC market. Is that too high? I don't know. OpenAI is already worth whatever,
Oh, yeah.
100 billion or some outrageous number.
Yeah, but let's say that that valuations are not straightforward, right? So never, especially for early stage. So how can we ensure these, like fair valuations? At least how can we try to have them?
I don't think you can. I think.
No way.
Well, here's the thing. If you're going to go the route of, I want to go to Silicon Valley and raise a lot of money and be one of the cool kids at the Silicon Valley parties and then go public for $20 billion. Okay, you have to go that route, and your valuations they want your valuation to be high. Like, these guys don't actually want to invest less than
Yeah.
$1 billion valuation. Yeah. But if you think you have some chance at getting a moat and you want to raise money, you cannot go the venture capital route. You have to go to aggressive friends and family. You have to find angel investors who used to start VC firms, but now they can't really. So you go to aggressive angel investors and friends and family, and you raise something at a $10-15 million valuation, and you say, look at Perplexity. I'm going to Silicon Valley next, and I'm going to be just like them. Or Moonshot AI. I can't even figure out what Moonshot AI does. It's got a multi-billion-dollar valuation, and it's in China. So I have no idea what anybody's doing with that. But
Yeah. I get you.
but again, to answer your question,
yeah, sure.
focus on, either how can you get users, how can you get a data that's nobody else can get, and then you can raise money. By the way, you should raise money at a lower valuation so you keep more control. So raise money, get your friends and family, get a nice terms for yourself, and then build, and then later maybe go to the Silicon Valley VCs. But I wouldn't start there.
Yeah, but like a follow-up question here. So you said that maybe it's better to fundraise with a lower valuation. So actually, from this perspective, like as a startup founder, what's actually better when your company is too, like the valuation is too high, or when it's actually lower?
It depends, of course, how fast you're growing, but here's the problem with too high. So I was talking.
Okay.
I was talking to the CEO of Gumroad. I don't know how many, any of you use Gumroad. Within 6 seconds, you can make your own e-commerce store. It's a pretty cool company. Anyway, they raised money initially at a $100 million valuation, and then when the CEO wanted to sell it, he couldn't. They had the venture capitalists had a liquidation preference, meaning he had to sell for $100 million plus $1 before he even saw any return at all. They had to get the first $100 million back, and so he couldn't do that. The Gumroad had lost valuation, so he was stuck. He had to fire all the employees. He was stuck with a one-person company for years and years, which still is around and it's doing very well. Until finally he bought it back from the VCs for $1, and now it's growing and flourishing. But because he had raised money at such a high valuation, it doesn't mean he was rich. It meant that it was much harder for him to get rich by selling the company. It's very hard to sell a company for more than $100 million, depending on where the market cycle is.
Yeah.
So he was screwed for a long time. So again, I would recommend raising money that you could build out your idea and your model, your business model, so that you could dictate who controls the company. You could dictate things like the liquidation preference, even if your valuation is much higher. So I always think that's the better route to go.
Yeah, thank you so much for sharing this. And this skepticism that LPs have regarding the startups' valuations. So, what does it lead to? Does it actually help fundraising, or does it actually make the fundraising process slower? If it does affect in any way.
Again, it depends what kind of, like if you're in Silicon Valley and they're all chasing you, fundraising is like easy. Oh, you want $1.5 billion valuation? Let's make it a $2 billion valuation. Well, you'll even be happier. And they love it. The VCs love it. The LPs love it because they're making, the same LP 6 months ago, they were in the VC fund that put in money at a 500 billion or a 500 million. Now the VC firm decided, oh, let's just make it $1 billion. It's just arbitrary. And now and then they write up, by the way, then they tell all the LPs, you're up 100%. By the way, it's the end of the year. We're taking our 20% fee of the profits. We count that as a double. So the VCs are taking more equity in these companies on paper valuations that they themselves set, not an outside party. So it's all kind of a big scam there. So again, I would stay out of that circle unless you're like a Perplexity where you have 10 million users, you're going to keep growing, you're already making $10 million a month or whatever it is. And so you could dictate terms to the VCs rather than the other way around. You always want to keep control of your baby as long as possible. So if that means raising money at a lower valuation, don't confuse your company's valuation with your net worth because it's far from it. You have to sell the company for your net worth to go up. So you're not selling shares to the VCs. They're owning more and more of you when they put money in, not the other way around. So again, there's two different models. There's the super VC model, and then there's kind of what I think is better right now is the angel investor, more friends and family or people or wealthy people There's that model. So the valuations are totally different. The moats are similar though, and so that basically, there's two models basically for what you're talking about in terms of the valuation scenario out there.
Yeah, but also another question is that a lot of experts say right now that LPs will invest more into, stay with the family offices rather than investing into some venture funds. So how do you see this trend in 2024?
Yeah, that trend is very important. So what she's saying is a lot of wealthy people form family offices. So they hire professional investors to run their family's money. Let's say their family is worth $1 billion, and they have a little office and they hire investors to manage it and so on. What those family offices do, they'll invest a little bit with the VC funds just to get exposure to that. But they'll also tell the VC funds, hey, if you do a deal that you're excited about, I'm only putting money in your VC fund because I want you to let me put in money on top of your money in the deal you're putting in. So Perplexity maybe had Andreessen Horowitz. I'm just using them as an
Today we
example.
talk a lot about that. So did they pay you for
No, no,
promotion?
I'm just using that as an example because it was like last month they got
Okay, okay.
their $1 billion valuation. But family funds might say, hey, we're going to put a little money in Andreessen Horowitz, but when you do a great deal, we want to piggyback that deal and put in money directly from the family office. So their incentives are often aligned with the big VCs. Again, you have to go to a lot of family offices before you find the right combination of risk taker and angel investor who will put money in at the lower valuation. They all perceive higher valuations are less risky, when in fact they're more risky in most cases.
Yeah, yeah. So definitely, and going back to this skepticism from LPs. So basically, if you're an LP, right? So there is always a gap between GP and LP. So how can you navigate, this process? How can you be more like careful or like more certain, about the evaluations and about like the current state,
Yeah, the key is you've got to find your own deal flow. So
your own deal flow?
you can't just rely on, because again, Sequoia, Benchmark, all of these guys are essentially scamming their investors. Like I said
Yeah.
before, oh, in June, this company had a 500 million valuation. In December, the day before everybody takes their 20% of profits, the valuation just doubled. Nothing happened. Just, oh, we're going to put in some
Ta-da.
money at $1 billion valuation now, and we take 20% of the profit we just made. The quote, it's not real profit, but it is profit on paper. They take 20% of that, usually in the form of shares, and now all the partners, all the GPs, but not the LPs, have a lot more of the company by themselves. The LPs did not benefit at all. So I'm not saying that happens with every firm, but that is a very common thing that happens for large hedge funds, large venture capital firms, and large private equity firms. They do this every year. You'll see valuations go up in December, and they take their they take their share, but now valuations at $1 billion instead of 500 million, so they have to do things to support it. By the way, then if they can't support it, then there's down rounds,
Yeah,
and
down
they're
rounds.
fine
Okay.
doing that too because then they get more of the company at a lower valuation.
Yeah, and so how do you evaluate the current, venture capital landscape? So is it really that hard to fundraise right now, in your point of view?
Again, there's more money than ever, but they're invested in fewer firms than ever. So you really have to be in with those fewer firms. Now, I think if you have a good company with one of these moats I described, and we've just been talking about software, but there's similar moats I could describe for hardware or services or whatever. So uh, I don't think it's that difficult, but it just depends what model you're working with. Are you going down up and down Sand Hill Road trying to raise money from the big VC firms? Then you need to show different things than if you're just trying to get angel investors. You're not going to find a $3 million valuation for a company which existed maybe 10 years ago, even like 5, 6 years ago, but you'll see valuations 10 to 20 million dollars, companies raising 4 or 5 million, and you can get in if you feel it's a good company. But again, you really have to know what you're doing. You have to make sure there's some sort of moat, some sort of reason, and then you have to ask, why am I so lucky that I am getting this special opportunity and it's not going straight to Andreessen Horowitz? Doesn't everybody want a $1 billion valuation? So how am I so lucky that before they called Mark Andreessen, they called me? You always have to ask that question with these companies.
Yeah, yeah, yeah. And wrapping up our conversation. So what trends? Oh, yeah.
I had this happen to me so many times where finally it became like almost a meme among my investor friends
Yeah,
where
yeah.
a company would pitch to us and they would say, listen, we know in the next round Bill Clinton and George Soros are going into this. We just need to raise the final 50,000 for this to fill out this round. And I'm like, is Bill Clinton really waiting by the phone asking, did James Altucher invest yet? Like, what's the deal? I'm waiting for James.
Yeah.
He's not doing that. So you always have to be careful of those situations.
Yeah, 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 yeah. Thank you so much. No, that's absolutely true. And so wrapping up our conversation. So, what trends do you see upcoming in this year in 2024? Do you expect more unicorns or less, more IPOs or less? A lot of people say that we're going to have more IPOs this year, because investors want to see their returns. So, what are your predictions? We just
Yeah.
started, right? It's March, so
I mean, look, we're about to see the Reddit IPO, I guess, and
yeah.
and in 2022, even in 2023, there was kind of not a lot of IPOs, and so the shares outstanding reduced. Part of the reason the market has been going up so well is that again, it's supply and demand. Demand has gone up because we might have a soft landing in the economy and the Fed's going to cut rates. So demand is going up for stock, but the supply of shares that are outstanding has gone down because there haven't really been that many IPOs and there's been acquisitions. So So there is going to be a lot of IPOs this year. Tech IPOs, other kinds of IPOs. There's a lot of companies on deck waiting to IPO. We're going to see a lot of IPOs. We're going to see a lot of M&A.
Okay, so we're going to see. Okay.
Yeah, we're going to see a lot of M&A, and you're going to see a lot of financing out there. Again, maybe limited at the $1 billion level to a small amount of companies, but still they've got, again, starting from the beginning, the VCs have $200 billion in cash in their checking accounts. Like they only make money if they use this money.
Exactly.
So they have to invest. So I think it's all going to be good. It's not really a bubble, but yes, there is this difference between the super high valuation companies and the lower valuation companies. And honestly, if you're an entrepreneur, try to be in the lower valuation companies unless you really can dictate terms, like with lots of users or a lot of data or whatever.
Data and users, yeah. So that's great. Thank you so much, James, for sharing
Thank
your
you.
insight. That was a really pleasant conversation. Yeah, and thank you so much, Lively and Grid Daily, for making this happen.
Yes,
Woo!
thank you guys. Thanks.